Let me start this video a little differently. If you watched silver collapse on Friday and thought, okay, maybe demand disappeared, maybe something macro changed, I want you to stop right there, because what happened on Friday was not a normal market move. It wasn't driven by fundamentals, and it wasn't driven by panic selling in the physical market. What happened was structural. It happened inside the plumbing of the precious metals market, in the part most investors never see. And once you understand how it happened, the price action suddenly makes sense. Not emotionally, logically. Setting the stage, why Friday was already fragile. Today is Sunday, February 1st, and let's rewind for a moment. January was brutal for banks and brokers who were short precious metals. Silver, gold, platinum, palladium, all of them rallied hard, too fast, and by late January, it was already an open secret in the market that some desks were underwater. Not down a little, down enough to hurt. So heading into Friday, the system was already fragile. Now here's the key point most people miss. This crash didn't hit stocks, it didn't hit bonds, it didn't hit other commodities, only precious metals. That alone tells you this wasn't macro. Anyone who understands markets knows that kind of isolation is abnormal. So what actually happened? But before we continue, welcome. Ken AG here. If you like this kind of analysis, subscribe so you don't miss the next updates. I'll be posting how this story develops throughout the week. Now, the quick disclaimer. The content in this video is for educational purposes only and represents my personal opinions and market analysis. It should not be considered professional financial or investment advice. Financial markets, including silver and precious metals, are volatile and carry significant risk. The first critical mechanism: two prices, two clocks. Silver doesn't settle everywhere at the same time. That's crucial. There are two key reference prices: the LBMA Silver Price and the Comex Silver Price. Here's how it works. The LBMA benchmark settles at 12 noon UK time. Comex settlement happens later using a volume-weighted average price, VWAP, between 1:24 and 1:25 p.m. New York time. That time gap matters because a huge portion of OTC silver contracts, especially contracts linked to physical, settle off the LBMA reference, not Comex, and many of those contracts expire into month end, which brings us to January 30th, the price dislocation, where everything breaks. On January 30th, the LBMA silver benchmark settled around $103.19, and later Comex settled around $78.29. Let that sink in. That's a $25 plus gap between two official reference prices for the same metal on the same day. That doesn't happen in healthy markets. That's not volatility, that's structural dislocation. And if you were short silver, that dislocation suddenly became profitable. Let me explain why this matters so much. When you trade precious metals, when you enter a contract to buy or sell silver, one of the first questions is, what's the settlement reference? Some contracts settle based on LBMA. Some settle based on Comex. Some settle based on other benchmarks. And the choice of benchmark determines what price you pay or receive when the contract expires. LBMA is typically used for physical settlement. When you're actually buying or selling real bars in London vaults, you reference LBMA. When you're trading futures that might not result in physical delivery, you often reference Comex. So LBMA tends to be closer to physical reality. Comex tends to be more financial, more leveraged, more subject to paper flows. Now imagine you're a bank with a large short position in silver. You're contractually obligated to deliver silver or settle contracts at month end. Many of those contracts reference LBMA. So when LBMA fixes at 12 noon UK time at $103, your contracts settle at that price. You're locked in. But Comex doesn't settle until hours later. And in those hours, if you can push Comex price down aggressively, you create a massive dislocation. The contracts that already settled at LBMA, those are done. But you can use the lower Comex price to offset other positions, to reduce margin requirements, to create hedges that didn't exist before. And if you're sophisticated enough, if you have enough capital and enough access to order flow, you can engineer that Comex collapse deliberately. How banks exploited the gap, step by step. Now let's connect the dots. By the end of Friday, Comex open interest dropped by roughly 8,000 contracts. That's not small. That means positions were closed. If you assume conservatively that those closures benefited from the LBMA Comex gap, you're looking at something like $1 billion extracted simply by forcing Comex prices lower after the LBMA benchmark had already settled. In other words, physical linked contracts settled at the higher LBMA price. Paper futures were crushed afterward. Losses were minimized or reversed. That's not speculation. That's arithmetic. Let me walk through the math so you can verify this yourself. 8,000 contracts. Each contract is 5,000 ounces. That's 40 million ounces. If you capture even a $20 spread on those ounces, that's $800 million. If the spread was 25, that's $1 billion. And that's just the direct futures play. But it gets worse, because while Comex was collapsing, other mechanisms were triggered, mechanisms that amplified the move and created additional profit opportunities for those who understood the structure. The ETF angle, where it gets even more uncomfortable. Now here's where it gets heavier. Let's talk about SLV. SLV is the largest silver ETF. It's supposed to track the price of silver by holding physical bars in vaults. When you buy SLV shares, you're supposedly buying a claim on physical silver. When you sell SLV shares, you're selling that claim. But SLV kept trading after the LBMA benchmark had already settled. Because of the Comex collapse, SLV traded at nearly a 20% discount to net asset value, NAV. Think about what that means. NAV is calculated based on the value of the silver bars SLV holds. Those bars are valued using LBMA as the reference. So even though LBMA settled at 103, even though the bars in SLV's vaults were worth 103 per ounce, SLV shares were trading at 80, 85 based on the Comex price. That creates a massive arbitrage opportunity. If you're an authorized participant bank, if you have the ability to create and redeem SLV shares directly with the fund, here's what you do. You buy SLV shares from panic sellers at $80. You tender those shares for redemption to the fund. You receive physical silver bars. Those bars are valued at the LBMA benchmark, around $103. That's $23 per share of pure arbitrage. And guess what? According to iShares data, SLV share count increased by about 51 million shares from Thursday to Friday. That's enormous. 51 million shares created. If banks fully exploited that NAV discount, if they bought shares at an average 20% discount and redeemed that NAV, they could have extracted up to $1.5 billion through SLV alone. Not by predicting silver, not by investing, by exploiting structure, by using the LBMA Comex timing gap to create a dislocation in ETF pricing, then arbitraging that dislocation through the creation-redemption mechanism that only authorized participants can access. But when SLV is trading 20% below NAV, when that dislocation is so extreme, APs can make massive profits. And the reason the dislocation happened is because Comex crashed after LBMA had already fixed. SLV shares trade based on real-time price, which follows Comex during New York hours. But SLV's NAV is calculated using LBMA for the underlying bars. So you get this massive mismatch. Retail investors panic selling SLV at $80 think they're getting out, but they're actually transferring wealth to APs who know the bars are worth 103 and will redeem at that price. Now let me give you the specific mechanics of what likely happened. An AP sees SLV trading at 80. They know NAV is 103 because LBMA already fixed. They start buying shares from retail sellers who are panicking. They accumulate millions of shares at prices between 78 and 85. Let's say they buy 10 million shares at an average price of 82. That's $820 million spent. Next day, they submit those shares for redemption. The fund calculates redemption value based on NAV, which uses LBMA reference. So they receive silver valued at 103 per share. 10 million shares times 103 equals $1.03 billion worth of silver. They spent $820 million. They received $1.03 billion. That's $210 million of profit. On one trade, in 2 days, with minimal risk, because the redemption mechanism is contractual. The fund has to honor it. And this isn't theoretical. The 51 million share increase in SLV from Thursday to Friday confirms this happened. That's 51 million shares created, meaning APs delivered silver to the fund in exchange for shares. Why would they do that? Because they could immediately sell those shares into the panic at elevated prices relative to what they paid for the silver, or they anticipated being able to redeem later at favorable NAV calculations. This is the part most retail investors don't understand. When you trade SLV, you're not really trading silver, you're trading a vehicle that's supposed to track silver. But that vehicle has mechanics, creation-redemption mechanisms, NAV calculations, timing lags. And those mechanics can be exploited when you have access that retail doesn't have. Leveraged ETFs, forced selling on autopilot. Then came the final wave, leveraged silver ETFs like AGQ. These products are designed to deliver twice the daily return of silver. If silver goes up 2%, AGQ goes up 4%. If silver goes down 2%, AGQ goes down 4%. To maintain that 2 times leverage, AGQ has to constantly rebalance. When silver moves significantly, AGQ has to buy or sell derivatives to stay at 2 times exposure. And this rebalancing is mechanical. It's not discretionary. The fund has rules. When silver drops, AGQ must sell. Period. So when silver collapsed on Friday, AGQ and similar leveraged products were forced to sell derivatives. A lot of them. Automatically. That selling pressure wasn't emotional. It wasn't discretionary. It was mechanical. And the brokers on the other side of that flow, they did very well. They knew the selling was coming. They could position ahead of it. They could lean into it. They could profit from the predictable forced flows. This is a pattern we've seen before. In 2008, during the financial crisis, leveraged ETFs created forced selling that amplified the crash. In 2020, during COVID, the same thing happened. Leveraged products have to sell into falling markets and buy into rising markets. That's the opposite of what you want to do. But it's what the math requires, and sophisticated players exploit it. Adding it up, the scale of the event, when you put all of this together, Comex futures collapse, LBMA settlement timing advantage, SLV NAV arbitrage, leveraged ETF mechanical liquidations. It's reasonable, conservative even, to estimate that banks and brokers extracted or recovered up to $5 billion in a single day, and likely more if you include gold, platinum, and palladium, which followed the same pattern. This wasn't an accident. This wasn't panic. This was engineering. This was a coordinated exploitation of structural weaknesses in the precious metals market infrastructure. Now, some people will say, you're alleging manipulation without proof. So let me be clear. I'm not alleging anything that requires conspiracy. I'm describing arbitrage. I'm describing how traders with access to order flow, with understanding of settlement mechanics, with the ability to move size, can exploit timing gaps and structural dislocations. That's legal. That's what markets do. But it's also something retail investors need to understand. Because when you see a $25 gap between LBMA and Comex, when you see SLV trading 20% below NAV, when you see leveraged ETFs forced to liquidate, you're not seeing a market. You're seeing a wealth transfer. From people who don't understand structure to people who do. What they broke in the process. But here's what matters going forward. They didn't just crush price, they broke alignment. Now there is a disconnect between paper and physical, a disconnect between exchanges, a disconnect between ETFs and NAV, a disconnect between price and availability. And markets don't like that. They can tolerate manipulation, they can tolerate volatility. They cannot tolerate persistent dislocation, because dislocation creates opportunities. If LBMA says 103 and Comex says 78, someone will arbitrage that. If SLV trades 20% below NAV, someone will exploit that. And as those arbitrages get taken, as people buy the cheap thing and sell the expensive thing, prices converge. Dislocations close. But the process can be violent. Think about what happens next. Physical buyers in Asia see silver at 78 on Comex, but they can't buy physical at 78. They have to pay 103, 110, 120 depending on form and location. So they keep buying physical. That drains inventory. That creates delivery pressure. That forces Comex to rise or break. Meanwhile, people holding SLV shares see the price crash. Some panic sell, but others recognize the opportunity. If NAV is 103 and shares trade at 83, that's a 24% discount. Buy the shares, wait for the dislocation to close. When alignment is restored, shares trade back to NAV. That's a guaranteed return if you can be patient. Why China and India matter next. Now zoom out. China and India didn't stop buying silver on Friday. They don't care about Comex games. They care about industrial supply. And that supply is tight, very tight, which is why physical demand likely rebounds quickly. Shanghai premiums remain elevated. India keeps absorbing metal. Paper price doesn't stop factories, and it doesn't stop refiners. China is the world's largest manufacturer. They need silver for electronics, for solar panels, for industrial applications. When Comex crashes, Chinese buyers don't stop producing. They keep buying physical, and they're willing to pay Shanghai prices, which are well above Comex. Same with India. India imports nearly 200 million ounces of silver per year. That's not speculation. That's jewelry. That's investment. That's cultural wealth preservation. Indian buyers don't check Comex futures. They look at local premiums and they buy. So, while Western traders are playing timing games between LBMA and Comex, Eastern buyers are accumulating physical. And that's the tension. Paper can be manipulated. Physical can't. And eventually, physical wins. Where we are right now. As of now, silver is trading around $79 per ounce, down more than 30% from the January peak near 122. That's extreme. So let's talk scenarios. Calmly, probabilistically. Scenario analysis. Bull case, approximately 60% probability. Physical demand reasserts itself. Dislocations begin to normalize. Silver rebounds toward 95 to 105 into the weekend or shortly after. This is the most likely outcome in my view because the fundamentals haven't changed. The deficit is real. Industrial demand is strong. Mints are still struggling to keep up. Physical buyers step in at these levels. Base case, approximately 30% probability. Volatility continues. Price chops between 75 and 85 while positioning resets. This happens if the forced sellers are done yet, if there are more leveraged positions that need to unwind, if margin calls continue. In this case, we get a period of consolidation, of range trading, before the next directional move emerges. Bear case, approximately 10% probability. Another forced liquidation wave, a temporary flush towards 60 to 70 before demand steps in hard. This is the tail risk. If something breaks, if a major fund blows up, if there's a cascading liquidation, we could see another leg down. But even in that scenario, physical buyers would step in aggressively. Because at 60, the discount to physical would be so extreme that arbitrage would force convergence quickly. These probabilities align with research from major banks, with analysis from commodities desks, with the fundamental picture. But they're probabilities, not certainties. Markets can surprise. Closing. What this really was, let me end with this. Friday wasn't about silver being worth less. It was about who controls settlement. It was about timing, structure, liquidity, and yes, power. But power games leave footprints, and this one left a very big one. If physical demand continues, and if Asia keeps absorbing metal, this dislocation doesn't resolve quietly. It resolves violently. Just not necessarily in the direction most people expect. Because right now, paper says 79. Physical says 110, 120, 130, depending on location and form. One of those prices is wrong, and it's not the physical price. So what should you watch for this week? What are the signals that tell you whether this was a one-time extraction or the beginning of something bigger? First, watch LBMA versus Comex spread. If it normalizes back to a few dollars, if the gap closes quickly, that suggests the dislocation was temporary. Exploitation happened, it's over, move on. But if the gap persists, if LBMA continues fixing significantly higher than Comex settles, that tells you the structural tension remains. That tells you physical and paper are diverging systemically. Second, watch SLV premium discount to NAV. If it goes back to normal, if shares trade within 1% of NAV, that confirms the arbitrage was taken and the opportunity closed. But if SLV continues trading at unusual discounts or premiums, that's a red flag. That means something in the creation-redemption mechanism isn't working smoothly. And when ETF mechanics break, it often signals deeper problems. Third, watch for Comex delivery data. February is a delivery month for silver. If we see large delivery requests, if people are standing for physical despite the volatility, that confirms real demand. That validates the thesis that the crash was paper mechanics, not fundamental weakness. Conversely, if deliveries are light, if everyone rolled to later months, that would suggest the crash scared people away from taking physical. Fourth, watch Shanghai Premium. Right now, Shanghai Physical is trading well above Comex. If that premium compresses quickly, it means Chinese buyers backed off. Demand weakened. That would be bearish. But if Shanghai Premium stays elevated or widens, it means Asian buyers are still accumulating. They don't care about Comex games. They want metal, and that's bullish for physical, regardless of what paper does. Fifth, watch for official responses. Did any exchange issue statements? Did regulators open investigations? Did major banks report unusual trading activity? Sometimes the absence of official response is itself a signal. If regulators are quiet, it means either they don't see a problem or they're choosing not to act. Both are revealing. And sixth, watch for follow-through. Does this pattern repeat? If we get another LBMA Comex gap next month, if the same mechanics play out again, that's not a one-time event. That's a new playbook. That's a structural feature that traders will continue to exploit until something forces it to stop. Stay calm, stay curious, and most importantly, understand the plumbing, because that's where the real story always is. The mechanisms that move trillions, the timing gaps that create billions in arbitrage, the structural dislocations that transfer wealth from the uninformed to the informed. This is not a conspiracy theory. This is market structure, and understanding it is the difference between being a victim of these events and being positioned to benefit from them. When you see a $25 gap between settlement prices, when you see ETFs trading 20% below NAV, when you see leveraged products forced to liquidate, you have a choice. You can panic and sell into the chaos, or you can understand what's happening, recognize the dislocation, and position accordingly. For me, understanding comes first, positioning comes second, and panicking doesn't come at all. Because markets are mechanical. They have rules, they have structure, they have exploitable inefficiencies. And the players who win are the ones who understand those mechanics before everyone else does. Thanks for watching all the way through. Make sure you subscribe so you don't miss the next updates. I'll be posting throughout the week as this situation develops. Because I don't think this story is over. I think it's just beginning.